Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today, in episode 319, we're going to talk about the next bear market, the next serious market crash. I'm not talking about when the market's down 1 or 2% in a day. I'm talking about when it's down 10, 20% year one, year two, year three. It starts to get really discouraging. It's going to happen. We don't know when it's going to happen, but we know it's going to happen. And so today I'm going to talk about how that could be that extended bear market that we all believe is going to happen eventually could be one of the best things that could happen to your investment portfolio, to your attempts to achieve financial freedom, maybe attempts to retire early, or heck, just to retire on time. That kind of bear market can be a boon for investors if, and this is kind of important, if we handle it the right way. Here's how this issue came up. I've been working on my book, as you know, and it's, of course, as you know, for sale now. I'm recording this in early August. It will be, it's available for pre-order now, will be released August 29th. And in the book, when I talk about investing, when I talk about how to achieve financial independence, I have to make some assumptions about future investment returns. And whenever you do that, you just invite some pretty impassioned responses. Either your assumptions are too high, your assumptions are too low. And in my case, in the book, I use 9.3% as my nominal return, meaning I haven't factored in inflation. And that's just based on Vanguard data over the last 100 years or so. A 70-30 portfolio has returned an average of 9.3%. And then when I want to factor in inflation, and I do that when I want to try to estimate how long it'll take someone to achieve financial independence, I back out of that 3% for inflation. Why 3%? Well, since about 1926, our country's averaged just under 3% inflation, 2.91% or thereabouts. And so I take out 3%. So even with those numbers and even using history, someone could fairly say, well, Rob, just because that's what happened in the past doesn't mean that's what's going to happen in the future. And in fact, recently there was an article on Forbes where they were really critical of sort of the FIRE movement in particular for the return assumptions. And this individual thought that we should assume an after inflation rate of return of 2.5%. Now that's pretty extreme. I've not heard anyone go that low before. But it made me think, well, let's forget FIRE for a moment. Let's forget those that want to retire early. What happens if over a prolonged period of time, let's say a decade or so, we indeed have very low returns? And let's even make it worse than 2.5. Let's just assume zero. Let's say we go a decade, and if we could fast forward, I'm actually going to use an 11-year period. You'll understand why I picked 11 years in a minute. But if we fast forward 11 years from now, let's just assume that 11 years from now, the market, however you define that, let's say the S&P 500 index, is at the same price it is today. That even if, and we'll even throw in dividends, let's assume you reinvest your dividends for 11 years and your compound annual growth rate is zero. Now, could we nevertheless do okay and actually make some money during those 11 years? It almost seems like a trick question. Like, wait a minute, Rob, you're telling me the return is going to come out to be zero, right? Yeah, I don't think we can make any money, can we? Maybe we could short some stocks or, invest in Bitcoin or gold. No, that's not what I'm talking about. Here's the deal. When we think about future returns and we make an assumption, it's a very smooth assumption. Even in my book, a 6.3% after inflation return, I don't get into the issue of, well, wait a minute, it may average 6.3, but that doesn't mean every year is going to be 6.3. In some years, we might have a gain of 35%. And in other years, we could be down 40%, right? It's going to be, in other words, it's going to be a very, very bumpy ride. And that raises the question, what does it matter? If you end up in some period of time in the future in the example we're going to use today, a compound annual growth rate of 0, does it matter how bumpy that ride is and where along the journey the bumps occur? Turns out that it does. So what I want to do today is give you a very simple example. Then I'm going to dive into a more, I'll call it realistic example, and going to show you a spreadsheet that I've prepared. So I highly encourage you to watch the video of this, but don't worry if you're just audio, I'm going to walk through it. You shouldn't have any trouble following it. But for those that do have a chance to watch the video, I think it'll help a lot. All right, so that's the plan for today. Before I get to it, one quick thing. As I mentioned, the book is available for pre-order now. It gets released August 29th. If you pre-order it, please remember, shoot me an email, rob@retirebeforemomandDad.com, with an image of your receipt. I will include you in a list. Remember, those that pre-order and send me that email with your proof of purchase, you're going to be part of a group we're going to start doing some webinars in September. I call them Ask Me Anything webinars. As I've said, it's Ask Me Anything about money or chess. That's open, that's fair game too. But ask me anything about money, investing, I don't care what it is, budgeting. It doesn't have to be about the book, anything related to money. And I'm not sure how long I'm going to do these for. It's going to be a couple, and I'm going to record them. So if you miss one, no problems, you can watch it. But it's sort of my effort. First of all, it's a thank you for those that support the book, but it's also my attempt to connect more with you guys. And we'll see how it goes. I mean, who knows? Maybe it's something I'll continue to do down the road. But that's the plan. So if you do pre-order the book, shoot me that email, rob@retirebeforemomandDad.com. Okay, so let me first show you the complicated spreadsheet. For those watching the video, I'm going to walk through it in a minute. And we're going to start with this section right here. And before we get to it, though, I want to sort of do a thought experiment with a much simpler example. Let's imagine we have, doesn't really matter the amount, but let's say $200,000. And we're going to invest it, and we're going to invest it for 2 years. And we know that in 1 year, we're going to double our money. And in the second year, our money is going to get cut in half. We're going to be down 50%. Does it matter which comes first? Does it matter if the 100% gain is in year 1 or in year 2? Well, it turns out if we invest a lump sum at the beginning of the period, it doesn't matter. Let's sort of walk through it. Again, we invest $200,000. Let's first assume that in year 1 we double our money. So after year 1 we have 400 grand, right? We've gone from 200 to 400. Great. Year 2 we lose 50%. So we've gone from 400, 50% of that is 200. We've gone right back to where we started, 200 grand. All right. Well, now let's flip the order. So now we'll lose 50% in year 1, and then we'll double our money in year 2. Do we still end up with the 200 grand? Well, we start with 200, we lose 50%. So at the end of year 1, we're down to 100 grand. And in year 2, we double our money. Look at that magic. We're back to that same $200,000. The takeaway here is if you think about investing as you put a lump sum in at the beginning of a period, the order of the returns doesn't matter. You're going to end up with the same result, right? Now, that's not how most of us invest. Some of us might for some periods of time, but most of us, we're putting in monthly contributions to our 401k, maybe monthly, quarterly, or annual contributions to an IRA, maybe a taxable account, an HSA. We're not just starting our careers off and sticking $1 million in Vanguard and saying, okay, I'm done. There's my lump sum. I'm just going to let it sit there for 50 years. That's not how most folks invest. And so that raises the question, all right, well, if we're not investing a lump sum at the beginning of the period, instead we're making contributions along the way, does the sequence of returns, that's the fancy term for it, does that matter? Well, it turns out it does. It matters a lot. And let's go back to our simple example before we get to the spreadsheet. Let's start with, instead of $200,000 lump sum at the beginning of the first year, let's assume we invest $100,000 at the beginning of year 1. And then we'll invest the second 100,000 at the beginning of year 2. Now does the sequence of returns matter? Well, it matters a lot, right? Because let's first start with the example of our investments doubling in year 1 and then getting cut in half in year 2. So we put in our 100,000, they double at the end of year 1, we've got 200,000. We then invest our second 100 grand, now we're at 300, and it gets cut in half in year 2, we're down to 150. All right, 150,000. Remember that number. Now let's just reverse it. We start with 100 grand at year 1. It gets cut in half this time in year 1, so we're down to 50. We add our second $100,000 investment, so that takes us to 150. And in year 2, it doubles. Now we have 300 grand. It's a big difference, right? The order of returns matters a lot in that example. It's a difference of either having $150,000 at the end of 2 years or having 300,000. Now, that's an extreme example, right? In 1 year, we doubled our money, and in another year, it got cut in half, right? Normally, investing is not quite that extreme. So what I want to do is lay out a somewhat more realistic model, if you will. This is where the video, again, will come in handy, but don't worry if you're listening in audio, I'm going to walk through it. And here was the idea behind the model that I'm going to walk through. Many folks say, and I guess I would agree with them, that the market is richly priced at the moment. Certainly if by the market we mean the S&P 500 index, it is what? It's trading at over 21 times earnings. In fact, I'm going to Google this real quick. PE of the S&P 500. You can use what's called the Shiller PE perhaps. But I think this site will do it. Bear with me. Yeah, here it is. So I'm recording this in early August. The current PE is 21.82, and the mean is 15.75 over a very long period of time, roughly 100 years, and the median 14.75. So the PE ratio, that's price to earnings ratio, of the S&P 500 is pretty significantly above the average. Now, it's not the highest it's ever been, but it's still pretty high. Now, one comment about that. Just because the S&P 500's PE is almost now just under 22, that doesn't mean your portfolio's PE is the same, right? Unless, of course, you've invested 100% of your assets in an S&P 500 index fund. The trailing PE of my portfolio, meaning price divided by the earnings over the last 12 months, is around 16 or 17. The forward-looking PE, meaning the price divided by the estimated earnings that companies will earn over the next 12 months, is even lower. It's under 15. Why is that? Well, I have my portfolio in foreign stocks, so a developed market index fund, emerging market index fund, some small cap. For my portfolio, I have some money in bank stocks, and they have much lower PEs. And so when you actually take a weighted average of my portfolio, the PE is significantly lower than the almost 22 of the S&P 500. Now, I don't mean what I don't mean to say is that in a down market, my portfolio won't be affected. It certainly will be, but perhaps not as much as the S&P 500. And in any event, whatever the S&P 500 PE is, what's most important to me is what my portfolio's PE is. So how do you find that out? How do you figure out the PE of your portfolio? Well, you could do it the hard way, right? You could get the PE of each of the funds that you own and calculate a weighted average. The easier way for me is just use Morningstar. You can get a free account. You can set up your portfolio in Morningstar. And in one of the views, it will show you both the forward-looking PE and the trailing PE, and that's what I do. I don't think Personal Capital has a similar feature. I do use Personal Capital as well. I think it's a great tool, but I don't think it has this feature. So if you're curious what the PE is of your portfolio, I think putting it in Morningstar and looking at it is probably the easiest way. And there might be others as well. So if you're aware of others, drop a note in the Facebook group, doorroller.net/Facebook group. I'd like to hear about that. But that's the tool that I use. So all of that said, even so, yeah, we've been in a bull market for a long time. And so in modeling sort of a bear market, if you will, I thought, okay, what happens if we go into an extended down market? And so the way I did this, and I'm going back to the spreadsheet, I assumed that an 11-year period. And what I'm assuming I'm using as my price is the price of the Vanguard S&P 500 Index Fund. The ticker's VFINX. It's currently trading at just over $270 a share, $270.86. And I assume, for now, for the sake of discussion, we're just going to put all our money in that, right? That's the high PE. That's the one everyone's scared about. So let's just toss all our money in there for the sake of this thought experiment. And I assume we did that starting in 2020. And in year one, we lose 10%. In year two, and this includes even with the reinvestment of dividends. In year two, we lose 10%. In year three, so now by the way, we're in official bear market. We're down a total of 20% after year two. Year three, we lose 10%. Year four, though, that's right, we lose 10%. So now we're 4 years in a row. Let's think about this. It's easy to run through this quickly, but let's take a breather for a moment. It's 4 years from now. We've lost 10% 4 years in a row. So what's happened? Well, one, you've clearly stopped listening to this podcast because I'm nothing but a Yahoo. What do I know? And you're probably now, I don't know, pushing all your money into Bitcoin. I'm not sure what's happening. Gold, I hope not. I hope not. But yeah, we're probably getting pretty tired of losing money, right? Well, it gets worse because in year five, we lose 10%. Year six, another 10%. Year seven, another 10%. By the way, at this point, the price of VFINX, the S&P 500 Index Fund, has fallen from $270 down to $129.55. I mean, it's been a bloodbath. Let's be honest. All right. But that's the end of the bear market, right? Because what follows a bear market? Well, a bull market, right? So in my model, I assume that in the next year, this would be year what, 8? The market's up 20%. It's up 20% again. The next year, another 20% after that. And finally, in year 2030, maybe by now you're listening to the podcast again. You gave up for a while, but you're back. Glad to have you. We're up 21%. Now you might say, well, wait a minute, Rob. What's up with the 21% at the end there? It's 20, 20, 20, and now 21. Well, I wanted to get the price of the VFINX back to its original $270.86. I came close. In this model, it's $270.88. So we've gained 2 pennies, all right? And then I'm assuming, just for the sake of discussion, this includes investment of dividends. This is sort of a total return model. So long and short of it is we have gained nothing, right? It started at $270. We had 7 years of pain, 4 years of gain, and we're back to where we started, $270. That's not a lot of fun. Now, for those watching, you'll see 2 sort of sections to my spreadsheet. In one section that I'm highlighting now, I decided just to assume a lump sum investment, right? We kind of talked about this at the beginning of the show. I assume in this case, we start with $100,000. We put it in today or the beginning of 2020. It's trading at 270, and we don't add or take away anything. It just sits there. Well, we kind of know what we're going to end up with 11 years later, right? Because the price started at 270 and it ended at 270. It's actually, and this is more for rounding reasons, I think, but the ending balance in my calculations comes out to $100,006.14. That may be the 2 pennies we get per share gain, but I think we can just acknowledge that if you start with a lump sum and you just leave it there and the market does crazy things for, it could be a year, 10 years, 100 years, doesn't matter. At the end of that period, if the market ends where it started, you're left with your 100 grand or whatever your lump sum investment was, right? Good, we got that established. Now let's get to something at least a little more realistic. What I did was, okay, that's not how most of us invest. So I'm going to assume that instead of a lump sum, you start contributing to a 401k. Maybe you're just out of college, got your first job, or maybe you've been out for a while and you've sort of neglected your retirement savings. But 2020 is going to be your year. And so you start maxing out your 401k, 19 grand a year. Now, I get it. Not everyone can do that. The point really isn't the number. That's just the number I chose for this exercise. And in year one, as we know, you lose 10%. So we're just going to assume you put 19 grand in at the beginning of the year, again, just to make the calculations a little easier. I know that's probably not how it works for most folks. It's more of a monthly thing, but we put in 19 grand at the beginning of the year. We lose 10%, right? We know that. So what happens? Well, the end of the year, the VFINX is no longer trading at 270. It's down 10%, so it's trading at about 243 bucks. Your 19,000 has fallen to 17,100 bucks. So you contributed 19,000, and you lost 1,900 bucks, at least on paper, right? Not a great year. Now, one thing to point out about this is, and this is going to become important as we work through this model, your $19,000 investment bought you just over 70 shares of VFINX, right? That's just how the math plays out. 19,000 divided by the $270 per share comes out to roughly 70 shares. That's how much you were able to buy on January 1 of 2020, right? At the end of the year, though, the price had come down to 243. You look at your statement, you've lost $1,900. You're probably not very happy, but you keep going. So in year two, you invest your another 19,000. Yes, the limits on 401ks could go up. We're going to keep this simple. It's going to be 19 grand every year. All right. After that investment, you have a total of 148 shares of VFINX. But here's the thing. Whereas in year one, your 19 grand bought you 70 shares, in year two, your same 19 grand, your new investment, your second investment of this 19 grand into your 401k, bought you just shy of 78 shares. You get 8 shares more. Why? Well, because the price it's cheaper. You're getting it. People like to say you're getting it on sale. I don't know if that's quite right. It may not. You probably won't feel like you're getting it on sale, but you are. You're getting it at $243 a share rather than $270. So your money goes further. You get 78 shares in year two rather than the 70 that you bought in year one. Now, we lose 10% again, right? Now we're losing 10% of a bigger number, right? In year one, it was 10% of 19 grand. But this time, we're losing 10% of the 19 grand we invested in year two, and we're losing 10% of the $17,100 we carried over from year one. So when we look at our gains and losses after year two, remember year one we lost $1,900. Now our total loss is up to $5,510. Not a lot of fun, but we're a glutton for punishment. So year three, we go in for another 19 grand. This time, we're able to buy more than 86.5 shares of VFINX. Remember, we started at 70 shares in our first investment because the share price was 270. Year two, we could buy 78 shares, roughly, because the share price had come down to 243. At the end of year two, the price had fallen again. Now it's down to 219 bucks, so that at the beginning of year three, we're buying over 86.5 shares. We're getting more for our money. Of course, we're still losing. At the end of year three, we're down 10,600 bucks. All right, I want to fast forward. I want to go to year 2026. So this is our 7th year of a 10% loss, right? Our total contributions to date after year 7 are 133,000. But our balance at the end of that year is only 89 grand. So this, by the way, this is when you cancel your subscription to the Dough Roller Money Punt. You unsubscribe, right? You probably don't throw your phone to the ground and curse me. Maybe you just curse me. I don't know. But you're done with the Dough Roller Money podcast, right? And you've probably, if you were gracious enough to buy my book, you've probably set it on fire at this point. No pun intended, by the way, with fire, huh? Anyway, we've lost $43,788.77. Not good. But every year we've bought more and more and more shares of VF INX with the same 19 grand. Remember, it started at 70, then it went to 78. Year 3, we bought 86. Year 4, we bought 96. Year 5, we bought 107. And year 6, 100 and almost 119. And then in the final year of calamity, I guess I'll call it, we bought 132 shares just that 1 year alone, our 19 grand, almost, not quite, but almost twice the number of shares that we bought in year 1. Are you seeing the benefit here of a bear market, of a falling market, right? Our investments, whether they're in the form of contributions or even dividend reinvestments, are buying more. All right. So in our model, I had the bear market last 7 years. And in year 8, the market's up 20%. Now, we still have losses. At the end of that year, our losses are cut in half, but we've still have a total loss of 22 grand, right? And it's that year, by the way, where we added 146 shares for a 19 grand, right? Because the previous year, the price had fallen to its lowest in my model, $129. In year 8, the market's up 20%. Now, that's good news, right? We feel better about this. You're thinking, okay, maybe this investing thing has got some legs. Maybe it's not all bad. Still down, but okay, not so bad. What happens in the next year, though, when we invest our 19 grand, we no longer get the 146 shares we got the year before, because yes, the market went up 20%, but that made VFINX more expensive, right? So the share price went from a low in our model of $129 up to $155. So in year would be 9, we bought 122 shares. Now, certainly a lot more than, remember the 70 we bought in year 1? Still a lot more than that, because the price hasn't gone back up to where it started. But we're buying 122 shares, which is a lot lower than the year before when we bought 146 shares. By the way, something to think about when you're getting all excited about a bull market. I mean, it's fun to see your balances go up. I like it when my balances and my investment accounts go up, but it means my investments aren't going as far. All right. So we go up 20% again. We finally, after 2 years of going up 20%, we finally have gains. Not a lot, but about $7,600. Our total balance is about $7,600 more than what we've invested. In year, I'll call it 3 of the bull market, the good news, we've gained now a total of 47 grand. We've got 237,000 in our account compared to total contributions of 190. But again, we're buying fewer and fewer shares of VFINX. Now we're down to just 101 that year. And in the final year of our model, we're up 21%. We're able to buy 84 shares, which is good, but not great, right? I mean, that's the downside of a bull market. But we've gained a total of almost $101,000. Now think about this. So we've invested 209. That's what if you add up the 19,000 times 11, we've invested 209,000. But our balance now is just under $310,000. How can that be? We started at a price of 270. We ended at a price of 270, right? And yet we've gained 100 grand. Well, as I'm sure you figured out by now, when you are making contributions as an investor, sequence of returns matters, and it matters a lot. And you can have over a period of time a certain compound annual growth rate. In this case, if you just looked at a share of VFINX, 0. But because we're continuing to contribute money year in and year out, the sequence of returns, how it is that we get from point A to point B matters a lot, right? Now, if you followed along closely, you might say, okay, Rob, I get that. But if that's the case, it kind of looks like you maybe fixed this a bit to make it look good. I mean, you've got 7 years of losses followed by 4 years of gains. And so it seems like you've kind of set this up in a way for it to look really good. And the answer to that is, yes, I have. That's exactly what I've done. To prove a point, to show you how important the sequence of returns are when you're still contributing. You're not just lump sum at the beginning of the period, but you're contributing year in and year out. Now, there is some logic to what I've done, right? Many people are just, have been predicting a bear market for a decade. Well, half a decade anyway. Eventually they're like a broken clock that's right twice a day. The bear market predictors are usually right about twice a decade. Maybe a little less some decades, maybe a little more others. And they will eventually be right. And we could go into a sustained period of losses. And so that's one of the reasons I set it up the way I did. But here's what we're going to do. I'm going to now change things. Remember, for those listening and not seeing the video, we lost 10% a year for the first 7 years. Then we gained roughly 20% for the next 4, each year contributing $19,000. And our total contributions were $209,000. And we gained $100,000 roughly, right? All right. Here's what I'm going to do. I'm going to make a change to this model. What I'm going to do is going to go into the formula. And in year 1, instead of losing 10%, I'm going to assume we actually gain 20%, right? I'll leave I'll put this in here, 20%. All right. And then to balance things out, I'll come down to our first 20% gainer, which would have been in year 8, and I'll just swap it. I'll say, okay, well in that year, instead of gaining 20%, we want to even this out, we'll lose 10, right? Now, if we look at the share price, remember the beginning share price was 270. The ending share price is the same. It's 270, right? The fact that I switched the sequence of returns doesn't change the beginning and ending. And it's also true with, again, lump sum investing. If you invest lump sum at the beginning of the period, you can move the sequence of returns around, doesn't matter. But when you're contributing, in this case, $19,000 a year, the difference is huge. That one little change, we lost half our gains. Our gains went from roughly 100,000 to now down to 50. All we did was swap out the first year as a 10% loss, made it a 20% gain, and year 8 was a 20% gain, we made it a 10% loss, and boom, $50,000 evaporates, half of our gains. Sequence of returns matters a lot. All right, now, I want to go back before, I am going to get to the so what here because it's really important, but before I do it, I want to go back to how we originally had this set up where we'd gained $100,000. I did some calculations to figure out what would our compound annual growth rate be. To start in year 1, contributing $19,000, to go 11 years and end up with a $100,000 gain. For those watching the video, you can see the formula. I just used a future value formula and kept putting in different interest rates until I got to our roughly our final number. And it turns out the compound annual growth rate's about 6.5%, 6.4%. So let's think about that. Let's put that in perspective. The market, flat. From beginning to the end of the 11th year, didn't gain at all. In between, lots of ups and downs, but because we were contributing during those ups and downs, and importantly, because we kept contributing during the bad years and didn't take our money out, we had a compound annual growth rate of 6.4% and a $100,000 gain. So, where do we go from here? I know what you're thinking. You're thinking, Rob, appreciate this, appreciate the spreadsheet. I kind of understand it. Maybe you do, maybe you don't. Hope you watch the video. But so what? How is this going to help me in my day-to-day investing? How is this going to help me retire early or even retire on time? So glad you asked. A couple of things. 1, it is absolutely critical to stick to your plan. The model I just walked through and the results that we got, we achieved them because we continue to invest, just like we always do, through good markets and bad. It would be wonderful if we were great at predicting, but we're not, right? None of this works if in year 4 of that down market, when you're in that 4th year of a 10% loss, you get fed up and you sell and you go to bonds or cash. The whole model falls apart. You lose all your gains. You may end up being worse than if you just left everything in cash to begin with. You've got to decide on your approach to investing, what you're going to invest in, your asset allocation, how much you're going to contribute, and you need to stick to it. And that's probably the hardest thing of investing. Coming up with an asset allocation plan, that's not too difficult, right? 70-30, 80-20, 90-10, they're all reasonable for those many years away from retirement. A reasonably priced target date retirement fund, fine. You want to use a robo-advisor? That's okay too. Yes, there's some more fees. You want to think about that. Those are the easy decisions. Those are the decisions that seem hard when you're just getting started. Reality is, those are the easy decisions. The hard decision is sticking it out when the market's fallen and it's down 2, 3 years in a row, 4 years in a row, unemployment's up, the economy's not doing well, maybe housing prices are stagnant or down. That's the hard part, is sticking to the plan. You have to. The second thing is, for those still contributing, still saving for retirement, frankly, a bear market's your best friend. If I were 25, man, I'd want a huge bear market. I would want a significant market crash. I wouldn't want anyone to get hurt. But yeah, I want a ginormous market crash. It's in my best interest, because now when I contribute my $19,000 to the 401k or whatever my contributions are, I'm getting those shares at a rock bottom price. The last thing I want is a bull market with PEs of 21 on the S&P 500 index. I want a bear market, and I want a crash, and I want it to last for a while. So keep that in mind when it does happen, because it will. We don't know when, but it will. If you're still contributing, you'll get far more for your money, and in the long run, we'll be better off. I am far better off today because of the 08-09 crash than I would have been if that never happened. But I didn't change my investment plan, and I kept investing through what was admittedly a very ugly market. Another thing to think about is that in this example, we used two different extremes, right? In the first one, we said, okay, lump sum investing, someone has 100 grand. They put it in at the beginning, at the end, they still have 100 grand. And then in the second one, it was, okay, well, they don't have anything to start with. They're just getting started, and it's 19,000 a year. A lot of you are somewhere in between, right? You have some amount invested, plus you're still contributing. If that's you, the numbers are not going to be as good, right? Because let's assume in the example where we're contributing 19,000, that you already have 750,000 saved. Well, that 750 that you already had at the start of this 11-year hypothetical time period is still going to be worth 750 at the end of it. That chunk of investment, right? And again, is making the assumptions we did. It won't go up or down in value by the end of that period, but your contributions will. The point being that when you calculate your compound annual growth rate over that time period, it's not going to be as high because a big chunk of what you have, right, won't grow. But it doesn't change the fact that your contributions, as the market goes down, will still buy you more and more shares of whatever you're investing in. So it's still a good thing for you, but I want to sort of set expectations for those of you that are sort of in the middle of all of this, halfway through your journey or whatever. The benefit won't be as great. If you're just getting started, you're out of high school or college or just getting started saving, man, a bear market is the absolute best for you, all right? Now, the last thing I want to point out are for those that are already retired or very near retirement. You're listening to all this and you're saying, Rob, that's great if you're contributing, but I'm not contributing anymore, or maybe you're about to stop contributing. Well, it's a very different situation. One of the biggest risks to our retirement portfolio and having it outlast us is sequence of returns risk. You can Google sequence of returns risk, and you'll find some great content on it. There's basically two approaches that I have found that I think are at least worth considering. And by that I mean to address the sequence of return risk if you're in retirement or about to retire. And to set the stage for them, the time period that's the most dangerous for retirees, and here I'm thinking more of folks retiring at a traditional age, are the first 5 to 10 years. If you retire at 65 and the market immediately hits a sustained bear market and is down 10%, and then the next year 20, and then down 30, it can significantly reduce the chances that your money will last you during retirement. All right, that's just a reality. It's called a sequence of returns risk, and it's a big deal. As you get older, it becomes less of an issue, and I don't want to get too morbid, but basically it's because you got a better chance of dying before your money runs out. I mean, that's just the reality. But when you're just hitting retirement, again, assuming, say, a traditional age, you might have a life expectancy of until you're 85 or 90. And those first handful of years in retirement are the big risk years. So there are two ways that I've found that a lot of the experts talk about addressing them. The first is the bucket strategy. I think probably those in retirement have heard of it. The idea is this: you put in either cash or other short-term fixed income investments like a CD or maybe a short-term U.S. government bond fund, money market fund, enough money to live off for some number of years. And it's as much art as it is science, but I've seen folks say, well, 2 to 3 years in sort of cash, 3 to 7 years in sort of short to intermediate term bonds. And then once you get out past 7, 8 years, it can be more of a mix of stocks and that sort of thing. And the idea here is, if you do retire and we hit that bear market and the stock prices are falling, you can leave your stocks alone because you've got the cash and the other short-term fixed income investments to live off of for a number of years. There's no guarantee. We don't know how long the bear market will last. But if you've got it out there 5, 6, 7 years in total, at least if we're playing the odds, you've got a pretty good chance of being able to draw down on those investments during that bear market, and it gives the market time to hopefully recover, rebound, and then eventually go into a bull market. That's the theory. Now, what I found in practice, and I'm not quite there yet because we're not living off our investments. I thought we would be, but we're not yet, is that I think it's a decent strategy, but I also think it's not always as easy as it may seem. I mean, on the surface, it seems simple. Oh, I got these couple of buckets. I'll put cash bucket for a couple of years and short and intermediate term a bond fund for, say, years 3 to 7, and then stocks for years 8 and on. That sounds easy. It is easy, right? But then, all right, year 1 goes by and you use half your cash bucket. Let's say you've got 2 years of cash in a checking account. You use half of it. And so now that bucket's short. You've got enough obviously for another year, and you've got your short and intermediate term bond bucket, but shouldn't you fill up that bucket? I mean, shouldn't you keep it at 2 years? Right? Isn't that the idea? Well, where are you going to take money from? Well, presumably you're going to take it from your stock bucket. But wait a minute, should you do that? It depends on the valuation of stocks, right? I mean, should you always just every year fill up the cash bucket with stocks? Or if the bond bucket has come up short, maybe fill some of that up too with stocks. That's where things, I think, get a little less certain with the bucket strategy. And I don't think there's a clear, clean answer to it. I can tell you my plan would be to basically look at market valuations and where we are in the market cycle. Is it an exact science? No. If I were doing that today and I just used a year of my cash, I would absolutely take a year's worth of expenses out of stocks without thinking twice and put it in the cash bucket. By the way, that doesn't mean that stocks won't go up by 25% over the next year, right? We can't control that. Yes, they seem to be highly valued, but that doesn't tell us what the next 12 months are going to look like. Anyway, the point is, I think the bucket strategy is a reasonable approach to dealing with the sequence of returns risk, but it's not quite as simple as I think some make it out to be. It's probably the strategy I'll follow, and I'm sure I'll follow it imperfectly, but just be aware of that. And if you're in that situation, I highly recommend reading up on the bucket strategy. And if you have a financial advisor, this is where I think I will really rely on, say, the Mark Zorrells of the world. For those who don't know Mark, he's the $96 a year investment advisor. And I will certainly run these ideas past him when I get to that time period. The second approach to dealing with sequence of return risk in retirement is somewhat counterintuitive. And here it is. When you reach retirement, the theory goes, really make your portfolio really conservative. Think 50-50 or even 40 or even 30% stocks and the rest bonds. And then as you get older and you move into retirement, slowly ratchet up the risk. It's almost the opposite of what people suggest. But as you're moving into retirement and you're in year 5, 6, 7, you'll add more stocks and more stocks. And you'll make your portfolio even riskier as you get older. And the theory behind it is you make your portfolio really conservative in the first few years of retirement because those are your riskiest years. Those are the years where you really can't handle a major drawdown with a stock market decline. And then as you get older, and really by that I mean closer to dying, let's be honest here, it's okay to take more and more risk because, your money doesn't have to last as long. You may not know when you're going to die, but I'm pretty sure that I'm 1 year closer to death than I was a year ago. And so as you age, you can actually think about making your portfolio more aggressive. And what they've concluded in some back testing is that this can increase the chances of having, I'll call it a successful retirement. Now, that raises a whole bunch of questions. What exactly should your asset allocation be in year 1 of retirement? And exactly when should you start to make it perhaps a little more riskier, if you will? Kitces has done a lot on this, Kitces. He's a financial planner, and so you can read a lot of his content on it. Maybe I'll do a whole show on just that topic alone, or maybe I'll have him on the show as a guest. Maybe that'd be even better. But I wanted to point those two approaches out. The real takeaway for today's show is this. When you're early on in your journey and you're contributing, don't be afraid of a bear market. It's the best thing that could happen to you. Even when you're sort of midway through and you've still got a while before retirement, you won't get the same boost as someone who's just starting out because you've already got a lot saved, but you'll still be better off than if the market just stayed flat or slowly went up because you're going to be getting shares of whatever you invest in at a discount. If you're in retirement and you're not contributing at all, you really need to pay attention to sequence of returns risks. It can be a significant issue in your retirement portfolio. The two strategies I found to deal with it, the bucket strategy, and then this sort of glide path, if you will, strategy where you actually start out very conservative in retirement and get riskier as you age. Those are the two that I've read about and have studied. I encourage you, if you're in that situation, to read up on them and talk to. I really think it's funny on the financial advisor side, the do-it-yourself investors, when you're accumulating, that's easy. It really is. Things get trickier in retirement. You've got a lot of issues to deal with. The one we just discussed, sequence of return risk. You've got longevity risk. That means you live longer than you thought you would. You've got the issue of which accounts should you draw from in retirement. You've got some, when should you take Social Security and how should you claim it? There's a lot of much more, I think, nuanced and sophisticated issues in retirement. To me, that's when getting a financial advisor to help you makes a lot of sense. You just don't need to have them manage your investments for a fee because that just gets crazy expensive, right? And there's plenty of folks out there that will just charge you a set fee and help you on an hourly basis. I know Rick Ferry does that, and of course Mark Zorrell does as well. To me, that's when they really pay for themselves, and I'll certainly be taking advantage of that when I get there, which is not too far away. Okay, well, if you're still listening, God bless you. I don't know how you managed to get through this podcast. I really don't. This was lots of numbers. Check out the video. It'll be part of the show notes when it gets published on doorroller.net. And I'm going to upload it into the Facebook group as well. So you can join that, doorroller.net/Facebook. And there it is. Love to hear what you think about it. Shoot me an email, dr@doorroller.net. Leave a comment in the Facebook group. And until next time, remember, the best thing money can buy is financial freedom.